Thank you for joining us today. My name is David Talbot. I'm Managing Director and Head of Research here at Red Cloud Securities, and I'm delighted to host another Red Cloud webinar on uranium today. We are going to hear from Peninsula Energy MD and CEO Wayne Heili. And during today's webinar, he will go through today's mine plan and outlook, and then we'll take some questions. You can type your questions into the chat box at any time, and we'll get to as many as we can. But before we kick things off, first we need to discuss the fine print as always. Now, during today's Peninsula webinar, forward-looking statements may be made. I direct forward-looking listeners to the company's forward-looking statements outlined on page 2, 3, and 4 of its corporate presentation. That can be found on the company's website, pel.net.au. For Red Cloud Securities, I'd highlight this webinar is for information purposes only. It should not be considered a solicitation or recommendation to buy or sell securities. We note this call does not consider the particular situation or needs of individual investors. Participants should really rely on their own investigation and seek their own professional advice before investing. So please see our most recent research outlined on the Red Cloud website, especially for specific disclosures on Peninsula. Now, today is Wayne Heili's coming to us directly from the Lance project in Northeast Wyoming. The mine and the ISR plant expansion is well underway, and to take advantage of him being on site, we'll have something a little bit different during this call later. After Wayne walks through his typical presentation comments, we're going to take a peek outside the window where construction is taking place and from where he is inside the existing ISR plant. And then after that, we'll take some questions, get to the Q&A session. But because we do plan this live video, remote video, while Wayne is on his cell phone, so please excuse any video issues we might have. So with that said, why don't I turn the floor over to Wayne to speak about the company. Wayne.
Thank you, David, and hello, everybody. It's a pleasure to be joining with you from the plant site today. I'm situated in the existing plant facility in the lunchroom, where you have a window looking behind me into the existing plant. And then a little later on, we can look right out the door window and see some of the construction going on the opposite side of the wall. So we have a lot going on. I want to tell you a little bit about Peninsula so that you understand the context of the construction and the work that's going on. Peninsula Energy is the parent company of holding the Lance projects in the state of Wyoming. I'm coming to you from Wyoming, and the Lance project is a world-class uranium ISR project in a Tier 1 jurisdiction, the state of Wyoming. So welcome, everybody, and I hope you enjoy this presentation, and it does continue to go off without any technical difficulties. Next slide, please. Before we get into the presentation, I'll share with you my important disclosures and disclaimers. Certainly, we'll be talking with some forward-looking statements, some forecasts about where the project is headed and where we expect it to land. We're a competent person who's reviewed the resources. We will talk about inferred resources. These are all important, and I encourage you to go to the company website and look over the company presentation disclaimers. Next page. So Peninsula Energy as a whole has the Lance projects as our flagship operation. It's a world-class, scalable, near-term uranium production asset located in Tier 1 Wyoming in the United States. Peninsula itself is a ASX-listed company, trading on the ASX with the symbol PEN. We also trade on the OTCQB markets under the symbol PENMF. Today, our plant and wellfields are being prepared and are on track for commissioning late this calendar year. The company sits in one of its strongest financial positions it's been in a very long time, with the current cash balance expected to fund the construction that's ongoing right into first operations at Lance and hopefully to the point of sustainable free cash flow. We have multiple additional growth opportunities beyond restarting and running production operations at Lance. We are looking to the possibility of We have some options out there, and if those are exercised, that funding will help us with our growth initiatives, and we're also pursuing potential debt facilities and working capital facilities to make sure we're financially stable in the months and years ahead. Today, uranium is in one of the more favorable markets. It's very dynamic, especially supportive of near-term production, and that's our ambition. We're hoping to be back in production, supplying this growing and constrained market right now. With the growth avenues here at Lance, we have some projects, the Kendrick, the Barber, and the Dagger projects that we can expand our footprint into and continue to grow the company's production profile into the future. So those are the highlights of the story that I'll tell you in the next couple of minutes. Next slide, please. And so I'll be providing a corporate overview. Next slide, please. Just briefly, I want you to know that Peninsula is managed by a very competent team with many years of uranium production and construction experience. These guys on this slide and many people below, we're now up to about 55 employees at the site. They're experienced, they're qualified and ready to go, putting this project back into production. Next slide, please. As a full overview, our market cap today is about $334 million Australian. Share price trading in the 10 to 11 cent range as of late. We have about 3.1 billion shares on issue. So we are a real Australian natured stock, a low price and a lot of shares out. Maybe we'll roll those back one day, but not immediately. We have about 337 million options out, priced at 10 cents. That can bring in another $34 million to our cash position should they be exercised in the next year. Our cash position at the end of this quarter, the June quarter, let me be very clear, this is estimated. It's not a final and audited number. We think we'll be around $97 million of cash at the end of the quarter. So again, we have the cash that we need to complete the construction activities and put the project into production. And we also have no term debt. So the board of directors has been with the company a long time and really knows the project and knows the nature of the company. They're doing a great job moving the project forward from a board's perspective. Next slide, please. We recently raised capital. That's no secret. We closed a placement and offering to our shareholders in the May and early June timeframe. With the cash we had on hand, which was around $50 million at that time, plus the cash that we raised close to $70, we were close to $120 million total, and that all was purposed for pre-production capital expenditures, for the ramp-up the capital money that we'll spend during production ramp-up, and then OpEx. So the uses of the fund, the working capital, and some other corporate costs are all accounted for, and this is why we state today that we're very well funded. We have a robust bank account allowing us to move forward with great efficiency. So, sources and uses of the funds on hand, you can see what we'll be spending in the near term. If we're not spending it, that's a problem, because our goal is to get this construction up and this operation running as quickly and efficiently as possible. So you'll see us go through some of this money pretty quickly in the next 6 months, but that's all good. Next slide, please. Just briefly, like any other responsible company, we have a focus on sustainability. I just want to point out to you that recently our project team has moved to now going over 7 years without a lost time or recordable injury at the project site. Very proud of that. That's part of our sustainability program, but we also care very much about the environment and take good care of and are good stewards of the environment and the area and the neighbors around our project site. Next slide, please. And moving on, this is the lay of the land for us in the northeast corner of the state of Wyoming. Well, this is the better part of the state of Wyoming, and you can see how many uranium projects are there. Lance is in the northeast corner. We have a lot of neighbors and uranium operations in the state. It's really a tier 1 jurisdiction. It's self-regulating. The state of Wyoming regulators are the people we turn to. We don't really have a report to any national regulators. We don't have to go to Washington, D.C. to talk to our regulators. We go to Cheyenne, Wyoming, and we talk to our regulators there. They advance our regulatory affairs and inspect our project, make sure we're compliant. Next slide, please. And this is going to drill down a little closer on the Lance project, which we've subdivided into 3 areas. I'm sitting in the red area of the Ross at the production plant. That's the fully licensed area. We have about 6 million pounds of resources remaining at Ross that are planned for production. We have 2 existing mine units. We're building a 3rd, and we expect to be able to build 1 or 2 more mine units over here at Ross. Then we'll expand into the blue area, the Kendrick area. The Kendrick has about 20 million pounds of estimated resource, including inferred. And sequentially, that's where we're going to be producing next. We have license applications in front of the regulators. When I said next, I was talking about the next production area. So I've moved the slide back. The Kendrick area is almost fully permitted. We're looking towards a decision on permitting before the end of this year easily, and well before we need it. Then we have the expansion area of Barber where we can explore. There's over 30 million pounds, 32 million pounds of inferred resources in the Barber area. And, collectively that's over, it's almost 58 million pounds of resource, which means that this is going to be a very long life, world-class uranium operation. Now we can go to the next slide, please. These are just quickly a recap of the resources. I'm not going to go through that with you right now. We have 58 million pounds of JORC resources between Ross, Kendrick, and Barber. We also have about 7 million pounds of resources at a project we call Dagger, which is not in the Lance project area, so it's not on this table. The Dagger area is about 20 kilometers away from the Lance central processing plant. So it's going to make a fine candidate as a satellite production facility in the future. Next slide, please. So today what we're really actively doing and what I want to tell you most about is our preparations for production at Lance. If you go to the next slide, we'll just recap a little bit of the history. Actually, this project was constructed and put in operations late in 2015 as a satellite facility, which meant that we relied on a third party to take our uranium-loaded resins and produce a finished product. Today, we're building the central processing plant so that we can produce the finished product ourselves. And when that central processing plant is complete, that's when we'll restart production. We have Wellfields ready. We have our existing plant ready. That's the area that you'll see in the behind me in the backdrop. But we're constructing the central processing plant, and it's all hands on deck at this moment. If you go to the next slide, you'll see what we're really doing is we're taking the previous process circuits, which relied on us loading ion exchange resins and transferring them to a full processing facility, and now we're going to do what you see in the lower part of the diagram. We're taking our ion exchange circuit, we're doubling the capacity so we can produce up to 2 million pounds per year. We're building the elution, precipitation, and product drying circuits so that we can produce a finished product. On the next slide, you'll see what Trent looks like, and in a few minutes we'll take the camera out to the window and look out on the construction area. On this slide, what you see in the light blue shaded on the left, 1/3 is the existing plant. That's the satellite plant that we have today. I'm sitting in that right now. And then to the right, the next, the right hand and the center 2/3 of the plant is the area that we're building. So we're expanding the plant area, really about threefold from what it is today. We're adding the circuits so that we can produce dry yellow cake. That construction effort is underway and funded, and that's what we'll be looking at shortly. But in the meantime, if we flip to the next slide, you'll see some of the construction efforts that have been going on. We've fully prepared our satellite plant for operations. It's ready to go, but we're waiting for the complete construction of the central processing plant. And you see a couple pictures of the concrete forms, some of the workers pouring concrete. Today we have about 30 contractors on site working on construction as I speak. They're out the window. They're continuing to form up. We're getting ready to pour about 220 cubic yards of concrete. The schedule has us pouring it early next week. So they're finishing the forms and the rebar and all that goes into preparing for concrete. We'll take a look at that. So a very big concrete pour coming up early next week. It'll be exciting. I'll be back on site, to see that happening. And we'll continue to report the progress of the construction as we go. Next slide, please. It's not just about the plant facilities, though. You have to have well fields and in situ recovery so that you can, consistently produce. We're building a new mine unit 3. That's very well along. Most of the production and injection wells are now installed. We're getting under reaming and starting to put surface facilities in. We had 10 drill rigs active on the site. We have construction crews building wellfield facilities, pipelines to the well fields, power lines, all the infrastructure that goes with it. That's all going along on schedule and on budget, according to our plan, so that we can start preconditioning the first part of mine unit 3 before the plant is ready. Late in the third quarter of the year and into the fourth quarter of the year, we'll get the wellfield solutions ready to produce uranium. So that when the plant is ready, the new wellfields will be producing uranium. Next slide, please. So this is what our timeline looks like, and this is a new slide, so I hope you appreciate it. Look, in May, we started the plant construction. By August, May and August, we're doing resource drilling and expansion of the well fields. By the end of August, we hope to have mine unit 3's first header house ready for fully installed and ready for operations. And then later in the third quarter, we may commence wellfield preconditioning as long as everything's on track. By the end of 2024, we expect to be able to start sequentially commissioning our new plant facilities. That means that in the second quarter of 2025, we'll have first delivery of produced yellow cake to one of our customers, and hopefully by the third quarter of 2025, which is really just around the corner now, less than a year away, we should have this project and the company in a position where we're sustainably free cash flow positive. That's what we're looking for. We'll keep you updated on that as we move along. Next slide, please. And again, just a reminder on some of the past features that have been installed into this company. If you go to the next slide, I present to you the life of mine plan. The key details of our economics are in this slide. We're preparing a 5,000 gallon a minute in situ recovery plant capable of producing up to 2 million pounds per year. It's licensed for 3 million pounds a year, so we can exceed 2 million if the solution grades are very good. Right now, out of the Ross and Kendrick areas of the mine, we expect production life of about 9.5 years, producing over 15 million pounds. That does not include the resources in the Barber area, which are contiguous, and there's over 32 million pounds of resource there that we can expand into. So this is really a long life mine. We expect with an average realized price of about $67 a pound in our model, an all-in sustaining cost in the low 40s, $42 a pound. Life of mine revenues around $1 billion. And our, again, our all-in sustaining costs, this is not C1, this is C3, fully loaded costs about $42.50 a pound. Next slide. This is the production profile that we're aiming for. We hope to produce around 1 million pounds in 2025 if we remain on schedule. Over the next 10 years, this produces almost 15 million pounds using the 2 million pound a year plant that we're building now. Steady state production rate can be up around 1.8 million pounds per year. But that's the profile of our production ambitions for the next couple of years. Of course, we can reshape that as the markets evolve and we have the opportunities to employ more capital into the project, to build satellite facilities and maybe add on an additional 1 million pounds a year. But that's all for future planning. Today, what's in front of us is getting this project up and running at this production rate. Finally, in the next slide, we do have offtake sales agreements. This slide shows you in green how much of our future production and sales that are committed to contracts and how much in gray are available for us to sell into the spot market. 2025, less than half of our production is committed to the contracts, so we should have a pretty comfortable ramp-up period. Even if things don't go perfectly, we'll have enough production to meet our customers' requirements. So that fills it out. Our average sales price from our contracts will probably be in the low 60s. There's some priced, it's base price escalated, and then there's some pricing mechanisms that are market priced. So our contract portfolio is very diverse, flexible, and allows us the ability to ramp up this project and sell uranium at a profit from the project into the contracts and then additional sales into the spot market. With that, Dave, I'll take a break and answer some questions, or perhaps we can now just take a minute to go around and take a look outside from where I'm sitting.
Yeah, that sounds great. Why don't you throw this, your screen up like that? This is just so we don't get car sick as you walk over to the window.
Right. And I'm trying to get the picture back. Apparently my finger's not warm enough. There we go.
Okay, great. One thing for viewers to recall or know is that Wayne cannot see what we're looking at because of the software. He can't use the other cameras. So this is usually the camera that looks towards you. So Wayne, angle it down a little bit. Yeah, we see some workers working on the rebar there.
Yeah, we're framing up the rebar. This is going to be the outer wall of the plant on the east side. And we're getting ready again. All of this wall, the outer retaining wall of the plant pad, will be poured early next week, and then you can see that we've poured some sumps and have the sump areas ready. That what you're looking at, kind of in the middle now, is where the main slab of the plant building will be. You get a good idea how large this is. Again, we're tripling the size of the plant, so there's a lot of work to be done. As I rotate, you'll see again some additional sumps that have been poured and prepared, the center wall of the plant, and then off in the distance, a little further away, you can see the west wall of the plant. So this area, again, we have a lot of workers framing and preparing rebar, getting ready for a big concrete pour that'll happen next week. Then off in the distance, you see our water, our wastewater ponds, our water storage and settling ponds. There's a building that we added this year that's going to house a filtration unit so that the lixiviant solutions, the Wellfield solutions coming into the plant, will go through a filtration system out in that building. We'll remove any fine solids and make sure that our ion exchange resins and system remain clear of any fine solid precipitants. Way out in the distance on the hillside, you'll see mine unit 1. That's an area that's been previously produced, but we'll return to mine unit 1 and recover some additional uranium with our new low pH chemistry set. And then across the parking lot and just beyond the flag and such, I expect that you see a laydown area. We've been ordering and procuring equipment. We have about 75, 80% of our equipment now fully ordered and procured, but a lot of it's arrived on site. You see some fiberglass tanks down in the laydown area. Those tanks are waiting for the slab to be done so we can set them on there and start plumbing them up. So, the contractor with over 30 people on site has done a great deal of procurement, advanced preparation and planning. And I'm happy to tell you that the construction today is on schedule, tracking budget, and well coordinated. Real pleased with the way things are going.
Yeah, Wayne, those tanks that you were showing us in the laydown area, there were white tanks, there were beige tanks or darker tanks. Are those specific tanks that ion exchange or water tanks? What?
Well, we in a separate laydown area that I don't have a view of from here, we have all of our ion exchange vessels. They are already on site and ready. These are tanks that will be used for precipitation. I think the white tanks look to me like they're the precipitation tanks. The darker colored tanks are eluent tanks. This is where we put the solutions that we strip the uranium off the resin in. So we have eluent tanks and precipitation tanks on hand right now, getting ready. And then the columns, the vessels are in a different area, but they're already on site. We also procured 2 product dryers that are off at a shop getting refurbished and prepared for operations. So again, all the major equipment, the long lead time items have been ordered. Everything today, David, is estimated to be on site in advance of the need. So things are moving very well.
Okay. And just to let us know where you are, you're up on the 2nd floor on sort of the southeast side of the existing satellite plant, which is about 1/3 the size of that new area that's being worked on.
Right. Yeah. And I don't know how good the image quality is. I get a little light reflecting from this window, but now I have you looking out on top of one of our water tanks. This particular tank was for permeate from our reverse osmosis units. We have a wastewater tank in the background here, and our ion exchange plant is not very readily visible from here, but you can see inside our existing plant, which was built in 2015. And again, we have that in a state of readiness. So we're just waiting for the new plant facilities to be completed, and sorry about that. We'll be good to go.
Excellent. Okay. Well, no, great, Wayne. That's the first time I've ever done that in one of these calls. So I think it went fairly well. So congrats.
I'm glad.
So yeah, let's now start off the Q&A portion of the webinar. Remember, everybody can type your questions into the chat box at any time, and we already have a bunch of questions here, Wayne. I guess, as far as staffing, other ISR companies in Wyoming have noted the labor shortages in the state. Are you finding that to be an issue right now, and are there any other senior roles that you still need to fill?
Yeah. No, actually, we're very well on the way with staffing. And we think when we're fully staffed and operating, we'll be around 60 employees. We have about 55 on site right now. Before this call, I was talking with a candidate who's a metallurgical engineer. We're looking at adding an engineering position, a chemist, and to the team. So we have a candidate on site there. Interviewing today. Other senior positions, there's really the company is looking to hire an operating officer at some point in the near future. We have some good candidates in mind there, but as far as employment goes, we're almost fully staffed for the start of production, and the people that we needed this year were construction and maintenance people. We have a good, experienced operator team. We've run this facility before. We've kept people around. When we were low on employment, we were around 35. Now we've hired up about 20. We also have 10 drill rigs on site, and they each employ 3 to 4 people. So we have about 30 to 40 contractors on drilling. So total employment on the site is closer to 100 people, plus now the construction crew, which is another 30 folks.
Okay. So once the plant's done and you take away the construction crew, do you expect to have that many drillers on site for a prolonged period?
Yeah, we do. We'd actually, look, if you're a water well driller in the state of Wyoming and you're interested in some long-term, work, contact us at Strata Energy, Peninsula Energy. We have work for you. We have 10 rigs now. We'd like to up that number a little bit so we can do some additional resource development drilling and exploration in some of the lands that we control. So 10 is not where we're going to end. We're going to add to that.
Okay, excellent. And in order to pay those guys, those contractors that you're looking to find and those on site already, you recently raised some equity here, both to expand the existing ISR plant and, like I said, allow you to go from Wellfields to drumming yellowcake. That you raised more equity after that to complete construction and cover working capital as well through break-even. Now, why the second equity raise so early in expansion, and why not maybe seek debt or other or offtakes or anything else like that?
Yeah, we were interested in being funded through to free cash flow positive, and not just funded to the point of having our construction complete. Once we have the plant built, we were going to need to solve for the early months of operations where you're building inventories and getting product ready, at the point of sale. So, it typically takes you 6 to 8 months to build enough inventory and have enough material at the point of sale, to make it sellable. So we wanted to be sure that our investors knew, without a shadow of a doubt, that we were funded to that point. And the fastest path for that in a good market was an additional equity raise. So we undertook that, and today we're sitting with a very healthy bank account, which should carry us a very long way.
Okay. You mentioned that the project is scalable as well. Can you maybe discuss what phase one will deliver and what production potential there might be down the road?
Yeah, well, really, phase one for us was the building of the satellite facility back in 2015. And that plant was designed to produce about 1 million pounds a year of uranium loaded on resins. Now we're building the central processing plant component. And we're expanding our production capacity so we can produce here in phase two, should be about 2 million pounds a year of capacity. And the plant will be built expandable so that we can go to 3 million pounds a year. What we can do in the future is build a satellite facility in the southern end of our project area in Barber, or build a satellite plant maybe in our new Dagger project, which is a very interesting ore body and higher grade and may produce some better economics for us than the Lance itself. We have the license capacity to produce up to 3 million pounds a year. We foresee, production of 2 million pounds a year from the area that's pipelinable to this plant facility. We can add 1 million pounds with a satellite plant in the south or a satellite plant up at Dagger. And if we really wanted to, we could probably expand the license capacity over time to go to as much as 4 million pounds a year. But, that's the project that we're sitting on. We have a 58 million pound resource and a 2 million pound a year plant. It doesn't seem like much, but it takes a bit of work to get to 2 million pounds a year. And, we'll be really proud when we get to that point.
Yeah, 2 million pounds theoretically would be largest producer in the U.S., probably next year.
Yeah. Largest singular project with one of the largest resources. This is a very interesting project, David. It's overlooked by a lot of folks, but today we're positioned better than we've been positioned for a very, very long time. We're getting ready for production. This is an exciting time. Like I said, the site's abuzz with workers. Everything's happening as we had scheduled, and we're looking forward to getting this project in production.
Mm-hmm. Now, what's needed before you can get to that second stage of production? Is it really just all about upgrading the resources at Barber? You said you had 32 million pounds, and then do you need to do an economic study after that, or is it a matter of just building for 3 million?
Sure. You know, our resources in Barber are largely inferred resources. You know, the 32 million pounds, probably more than 30 million are inferred resources. That means that they've been defined by white space drilling, and we need to get back in with drill rigs and define them on closer space drilling to make them measured indicated resources. You know, that then we can do some good economics on them. I know we've been reluctant to do economics on that big of a chunk of inferred resources, and for good reason. That's not what the system's meant to do. You know, you should be doing your economics on measured and indicated resources. So first step for us is to get some drill rigs out there doing some resource definition, upgrading the quality of the resource, and hopefully along the way also upgrading the quantity of the resource, which has, you know, been a part of our past experiences. When we do closer space drilling, we've been able to expand the quantity of resource as well as improve the quality.
Okay. Now you did give us some timing here on things, but maybe just remind us timing: first production, full production, break even, and then potential expansion.
Right. So as the year goes on, the first thing you're going to see from us in the production and operational front is preconditioning of the well fields, you know, mine unit 3 and portions of mine unit 1 and 2 that, you know, we want to move back into. Preconditioning is lowering the pH of the groundwater to the operational range that we need to run for the low pH in situ recovery. That typically takes 2 or more months of preconditioning operations. So as we see the plant getting ready, we'll pull the trigger and start preconditioning the well fields. Then when the plant is ready for sequential commissioning, you know, stage 1 will be taking well field solutions into the plant and starting to capture uranium on ion exchange. You know, we hope to be doing that before the end of this year, calendar year, and then moving loaded resins into the elution circuit and then commissioning that and getting that working, and then commissioning the precipitation, filtration, and product drying circuits. All of that will happen in the, you know, fourth quarter to the first quarter of next year. So we have a lot of sequential commissioning. As uranium reports into the plant, we start moving it through the plant, building inventories and producing yellowcake. But it's, you know, late fourth quarter this year for plant operations. You know, when we start capturing uranium on resins, you know, that'll be a point of first production. When we dry the first yellowcake, that's another measure of you know, finished product produced. When we start shipping and selling, you know, that's second quarter, third quarter of this year. You know, it's all going to move very fast. Second quarter
next year.
Next year, yeah, 2025. It's all going to move very fast for us. Fortunately, we do have the experienced operating team in place. So we're not taking new folks and teaching them a new job. We're taking experienced folks and putting them back to work.
Good. And another quick question here on the construction side of things. What percentage of your construction costs right now are locked in, and do you expect inflation to be much more of a concern on the balance of the costs?
Gee, I don't have that. You know, from procurement, we were about 75% of our equipment procurement locked in, and the remaining 25% is smaller bits. We've been able to maintain as a whole the budget for the equipment. You know, there were some wins, some losses. You know, but as a whole, we've respected the budget on procurement. We expect that to be maintained. You know, construction is going to be going on for the next 6 months, and you know, got some big bills ahead of us on that front. So you know, pouring concrete. You know, we have the building on site, the steel for the building. We have you know, a lot of the materials that we need for construction on site. So you know, we've been doing a lot more procurement, and we think that we'll be pretty good on inflation now. Things are respecting the budget.
Yeah. And sorry, maybe one quick breakdown on the cost, the major costs of production versus labor, raw materials. And this is not construction, but production.
Oh, on production, Probably chemical costs are going to account for 40 to 50% of our direct operating costs. Labor is typically another 20 to 30% of our direct operating costs, and then electricity rounds that out. Direct operating costs are mostly chemicals, labor, and electricity. We have purchasing agreements for the chemicals. We have the manpower on site. We'll have a good idea of what those costs, and we've put that into our model and projected that for the public to see.
Yeah, okay. And once in production, do you plan to run the plant 24/7, and how often might you need to shut down for maintenance?
Yeah, no, this plant will run 24/7, 365. We pump solutions through the well fields. We're hoping to bring the flow rates up to close to 5,000 gallons a minute and run that 24/7, 365.
Okay, good. And any desire to carry out any further M&A, pick up additional projects, satellites? You did pick up, like you mentioned, you picked up the Dagger project last year, which I think is what, 7 million pounds?
Yeah, and the Dagger project has room for growth in and around it. We have some initiatives, in the works there. There's some additional resource that we're familiar with in our neighborhood that we'd like to grow, our company more organically than through mergers. We know this neighborhood well, and we know we have a production center here. We're going to keep focusing on this Tier 1 jurisdiction in Wyoming. If other opportunities come along, we're certainly open to looking at them. But today our focus is very clearly on getting this project into production, and M&A, that can come down the road when we have this running well.
Because I guess you really don't have any excess capacity planned at the central processing plant right now, right? 2 million pounds is what you're going to use right away. 3 million pounds is what you're going to use when Barbara comes on. So.
Yeah, that's right. And we're building for our license capacity and what we think is optimal for this project. We're not planning on filling our plant capacity with somebody else's feed. We want to feed our own feed and control our own production and destiny.
Okay. Now you're constructing Wellfield number 3 right now, and you showed us that through the window. Can you tell us why you're starting at number 3 and why that's better than restarting at Wellfields 1 or 2 out of the gate?
Well, Wellfields 1 and 2 have been previously operated under the alkaline chemistry. We built those and ran them in the past. We've recovered 40 to 50% of the uranium out of Wellfields 1 and 2. We kind of view those as areas where we can add supplemental flow and get some good uranium, some residual uranium out of there, but they're not the backbone of an operation. You need a new well field to charge up your uranium grades and have good uranium production performance from the get-go. So, our production plan is backboned on mine unit 3, which is coming along very well, and we'll be ready for operations, as needed. And it'll be supported. We'll be able to produce additional pounds out of the mine units 1 and 2 area where capital is sunk, and those areas are now ready for operation. We just have to precondition them to acidify them, and we've tested through our pilot testing programs, to show that they have additional uranium to give. So, we modeled that, and we're looking forward to running both fresh well fields and some of the older areas to supplement.
Okay. Now, what are your plans with respect to the number of shares outstanding, let's say in regard to attractiveness to new investors?
Yeah. Well, look, for us, we're a North American project, a U.S.-based project. There's some good sense in us obtaining a North American listing along the way. In order to do that, we'd either have to roll back, and I mentioned rollback in the presentation. We'd either need to roll back our share count and get our share price, up, $4 or $5 a share rather than 10 cents. It's a big rollback. We'd do it, but probably when it's it's important to do it when we're preparing for a listing. With the cash in hand and the work that's going on now, we don't see an immediate need to do that. But I agree with you. I think a bundled share or a rolled back share would be a more attractive to the North American markets, and that's in our long-term planning.
Okay, let's discuss offtakes a little bit. You mentioned that you've got about 6 million pounds sold forward. Do you plan to arrange any more offtakes to take you above your 40% coverage, production coverage?
Right. Well, as you can see from the slide I presented on our contracts, the first couple of years of production are properly spoken for. That is 2025, 2026, 2027. We probably have as much of our production obligated to contracts as we're ever interested in doing. We do have some available for the spot market, and that's very attractive to us and to our investors to have that opportunity. So when we are looking at rolling in additional sales agreements or contracts, we're really looking at the period of time in the future where our volumes are rolling off or coming down. And so you can look at that slide in our presentation, the contract slide, and you'll see, 28, 29, 30, that's really the contract window that we're more interested in. And that's still a contract window that's, presenting itself, but not very frequently. Utilities will look for contracts starting in 26, 27 right now. So we got a little bit of time. We're comfortable with our contract book the way it is. It supports our operation and gives us the opportunity to sell into the market at the same time.
Mm-hmm. So that market right now, you've got spot uranium sitting about $85.50, and you've got the long-term price about $79 right now. Or do you feel that utilities are ready to sign offtakes at these levels? And at least in the U.S., are those nuclear utilities showing any more urgency than they did, say, late last year, earlier this year?
Well, I think the market is moving from a spot market to a contract market. Really what happens is when the spot market gets well out in front of the long-term market, the market has to take some time to equilibrate. What you expect is that the long-term contract pricing provides some incentive for producers to sell into the long-term contract rather than be exposed to the spot market. Today, the spot market's still higher than the term contract, but it's merging, it's coming closer together. So we're in that window where, in my view, the markets are equilibrating right now after the spot market got, way out in the front foot. And you see the spot market coming down a little bit, and you see the term market coming up. That's natural. That's good market behavior, and, that'll open a window for more spot. But today, we're seeing term contracts written at good prices, and the term market's more attractive to the utilities than the spot market because it's priced better.
Mm-hmm. Yeah, if I remember correctly, I think spot and term prices were about $75 a pound before Fukushima happened. So we're actually above that in both spot and term markets right now. So that's definitely a positive.
12 years later, and we're finally back. Wow, it's been a fun run.
Yeah. I think some of those years blend in together, or that's at least our age. So what uranium price was your economic study completed at, and how sensitive are your project economics to these higher prices?
Well, it's quite sensitive, actually. Of all the sensitivities we run, we found our sensitivity to uranium price is the most important. We did our project economics at something like $75 a pound for the uncommitted production, and then we were quickly shown to be very conservative in that respect because the price ran up over $100 a pound. Look, back when we authored our mine plan and feasibility study in August of 2023, I think we said we had a very significant NPV improvement for every 5% increase in the price of uraniums. And there's a chart there ran out to $100 a pound then in that presentation. I don't have that in front of me. I can't cite the numbers, but we're very sensitive to the price of uranium. We have quite 60% of our material is uncommitted. So and a portion of the committed stuff is market-based pricing anyway. So we have a very, very good exposure to the upside of the price of uranium, even though we have a very solid contract book to base our decisions on.
Right. And I guess, maybe last question, or maybe I'm going to combine a couple questions here to close things off, but any geopolitical risks specifically relating to your restart, and then maybe go into it. Somebody else mentioning, uranium prices hovering around $43 before the Russian invasion of Ukraine. Today, it's about twice that. Can you maybe comment on your expansion plans? Are those banking on a continuation of that war? So what impacts might geopolitical events have on the price, and how might that impact your decisions?
Yeah, well, I don't see a near-term end to the war in Ukraine. I think that Russia's in the penalty box for a very long time now. Even if the war ends, Russia's going to remain in the penalty box. The geopolitics of uranium is very interesting, but even when the U.S. government banned the importation of Russian uranium, we didn't see a big reaction in the uranium markets. I think it was kind of built in at that point, anticipated and fully understood that that was not an if question, but a when question. And now it's happened. We know that we won't be buying additional Russian fuel. To me, the sanctions or the waivers, the ability to ask for waivers and to bring in additional Russian material, it's probably going to have a very little impact on the market. The market is as strong as it's been for uranium in a very, very long time. We have a great deal of interest in domestic uranium production here in the United States, and we buy a lot of uranium from friendly nations, and that's a good situation to be in. The world needs more uranium mines. The price of uranium is going to reflect that for a very long time.
Yeah, maybe I'm going to add one more question here, Wayne, because you're in the U.S. and really we haven't heard how lenient the DOE has been on nuclear utilities with respect to gaining waivers to allow them to buy Russian uranium in the short term. Any word on that? Do you know if they're giving out those waivers, or they have to come to U.S. or at least friendly countries?
To my knowledge, no waivers have been granted. The utilities have to apply for them. They have to be considered. There's been a lot of speculation that waivers are going to come easy, but I have a different belief system. I don't think that waivers are going to be easy to obtain. Congress, and the will of Congress and the Senate and the President was that we banned Russian uranium, and the DOE should not be overriding the intent and will of our government by making it easy. So, I have a firm belief that waivers are not going to be easy to obtain. Again, we have no evidence one way or the other because no decisions have been made, and I don't even know if anybody's applied for waivers yet. So I don't know if there's any applications in front of the DOE. So everything's pure speculation, including what I just said. But I'll share with you my opinion.
Yeah, how much inventory do you believe most U.S. reactors have? How long can they last before they run out of, at least the ones that are buying Russian material?
They're all positioned pretty well with fuel. They've all said that they had, they've always maintained about 2 years worth of feed and inventory. The war in Ukraine is more than a couple months old now. It's a couple years old. They've had a lot of time to prepare. I know that they were out there securing conversion and enrichment services, in anticipation of the possibility that supply from Russia got cut off. I believe that the utilities, the fuel buyers, continue to be a smart, savvy bunch of business people who look out for their long-term interests, and not one of them's interested in being the first guy to run out of fuel. So, look, they're long-term planners, they're smart people. They'll be situated well, and we have the U.S. Fuel inventory that we can always tap into in the event of worst comes to worst. There's 6-8 reloads in the U.S. government's hands right now that can be released into the markets in the case of emergency. And I'm sure there's other fuel around the world that can be freed up for anybody who finds themselves in a pinch, but I don't think that's going to happen anytime soon.
Okay, well, let's wrap it up there. So Wayne Heili from Peninsula Energy, thank you for joining us today.
My pleasure, David. Thank you.
Okay, thank you everybody else for tuning in. Our next webinar is tomorrow. That's Wednesday, July 10th at 2 p.m. Eastern. That's when Alina will sit down with Brunswick Exploration. So everybody have a great day, and thank you for supporting Red Cloud's webinar series. Take care.